Welcome, and thank you for logging into this resource, which is dedicated to providing you with additional information about St. Catharines, along with some effective strategies around investing in this region. As you may know, St. Catharines has been one of the fastest growing and price appreciating marketplaces in the country, primarily based on underlying economic factors such as increasing average income, decreasing unemployment, positive net migration, declining lending rates, the effects of transportation, and most recently, what we call the ripple effect. When it comes to employment, the largest employers in St. Catharines are Brock University, Niagara Health System, and Niagara District School Board. These are all government-backed, well-paying, secure jobs. St. Catharines is the only city in the Niagara region designated as an Ontario Growth Centre by the Ontario government. The city has seen an unprecedented level of activity in its downtown core, with over $300 million invested in properties that have changed the face of the city for generations to come. This activity has spurred private investment and garnered interest in its downtown revitalization, inspiring new businesses to open, all while catching the attention of investors from across the country. St. Catharines is located along the Niagara Peninsula, and development is restricted by Lake Ontario to the north and the world's largest greenbelt to the south and west. Furthermore, it is also restricted by the Niagara Escarpment, a global biosphere. Essentially, in St. Catharines, they are running out of land to build on. As a result, St. Catharines is gearing up for a significant amount of intensification between 2021 and 2041. St. Catharines has also recently experienced a shift in migration, whereby the largest source of population growth has come from interprovincial migration and non-permanent residents. Many of these new residents are looking to rent while they get to know the city, which is a great opportunity for landlords. The city of St. Catharines is expected to grow by 168,000 people by the year 2041. This equates to over 80,000 new jobs. Under the GO Strategic 2020 plan, the GO by Metrolinx is planning on converting trains from diesel to electric, which will have a significant decrease on commute times, along with increasing frequency of traffic and additional stops through the Niagara corridor and right into Niagara Falls. The recent effect of COVID on housing has really fueled what we refer to as the ripple effect. As a result of more virtual workplaces, many homeowners and tenants from Toronto area are leaving the city, and they're residing in larger rental properties and homes in outlier communities. Essentially, people are driving until they can qualify. As a result of these moving economic forces, more and more residents are moving into the Niagara region. A recent study by the Canadian Centre for Economic Analysis found that single-person households were the most dominant type of households in need of housing. And with a trend of an aging population, the city acknowledges the current mix of housing selection does not align with the future housing needs. As a result, the region's official plan promotes a diversity of housing stock to support the need for single-person households. For those of you savvy investors that are looking for some fundamental metrics, get your pens ready. The average home price in St. Catharines is $650,704, which is up by 4% versus last year. When it comes to vacancy rates and average rental rates, a one-bedroom is 3% and rents for $1,543 per month. A two-bedroom's vacancy rate is hovering around 1.4% and rents for $2,006 per month. And a three-bedroom vacancy rate is 1.1% and rents for $2,304 per month. One of the most common questions that I'm asked almost daily is, how's the market? And whether you realize it or not, when you are asking this question to an analytical realtor, what you're essentially asking is, are we in a buyer's market, a balanced market, or are we in a seller's market? The market intelligence tool to find the strength of the market, or otherwise what's known as the absorption rate of the market, is what we refer to as months of inventory, or MOI. A seller's market is defined as 0 to 4 months of inventory. A balanced market is defined as 4 to 6 months of inventory, and a buyer's market is greater than 6 months of inventory. In St. Catharines, we are currently sitting at 5.3 months of inventory, which is considered a balanced market. As an investor, all of these metrics are really important to help identify short-term and long-term strategies, as well as negotiation tactics. The most effective investment strategy that we see in St. Catharines is the long-term buy and hold, and this is because of the realized and ongoing forecasted price appreciation and the relatively strong positive cash flow. Come join me as I share with you a recent success story as how one of our clients effectively used the strategies to grow their portfolio and build generational wealth.
Hi everyone, it's Shauna here from the Huddle Group.
I'm going to share with you a recent client success story that investor clients of ours have just purchased. We're going to talk about the strategy we were trying to achieve, how we got there, all while navigating the St. Catharines real estate market. So for these clients in particular, we knew that we wanted a legal property that had next to little maintenance. So when we came across 183 Reichert Street, we knew it was going to be the right fit. The property is located in the Western Hill neighborhood in St. Catharines, which checked all of the boxes in terms of demographics that the landlords wanted to attract. Now, the property was newly built back in 2021 as a purpose-built duplex. So this means that it is complete with city inspections, fully separate units, and up to date with current building code. Given that it was newly built, it of course came fully vacant, which was also very important to these purchasers because they wanted to make sure they could screen their own tenants and make sure that they got the A+ tenants in there to take care of the property. Now, one of the best features of this home is because it was built in 2021, it's actually going to be exempt from any provincial rent increase guidelines. We were able to secure this property off market before it even hit the MLS. The financial outlook here looks very favorable, and I'm going to walk you through what that looks like. So because the property was vacant, we were using market rents to forecast our monthly income. Once it actually came time to advertise for rent, we were able to get $100 more per month than what we originally forecasted. So in this situation, that worked out to be $4,150 per month. There is no other income coming in on this property, but for example, if you had, say, a detached garage or coin-operated laundry, the income from those sources would be captured here. Now, we always factor in our standard 3% vacancy rate as well, leaving us with a gross operating income of $4,026 per month. Looking at our expenses, we of course have our property taxes and insurance. Utilities, the only utility the landlord pays in this situation is water. So there's separate hydrometers and separate gas meters, meaning that the tenants can pay their own utility expense directly for those two services. Even though it's a new property, we still always factor in a standard 3% repairs and maintenance budget. And there was no property management fee incorporated here because the landlords were going to take that on themselves. So that leaves us with monthly operating income of $675 per month. Now, looking at our monthly debt service, these investors in particular decided to put a 25% down payment. We're able to secure an interest rate of 2.5% at the time, meaning that the monthly mortgage payment is $2,728 per month. So now that we know our income, our expenses, and our debt service, we can easily calculate our monthly cash flow. So we take our gross operating income minus expenses minus our debt service, leaving us with positive cash flow of $623 per month. Now, there is still one more piece to this analysis, and that's the 4 ways to win. But first, to calculate that, we need to look at our total cash invested, or otherwise known as acquisition costs. And those are comprised of your down payment, any initial improvements or renovations you want to factor into the purchase, home inspection, appraisal, land transfer tax, and legal fees. In this situation, total cash invested worked out to be just under $250,000. So, based on our total acquisition cost, the 4 ways to win formula is going to look a little like this. The component of ROI comprised strictly from cash flow works out to be just over 3%. The ROI from principal recapture works out to be 6.33%. Passive appreciation is calculated based on a 5% annual market appreciation, leaving the ROI component in this case to be 18.57%. You'll notice here forced appreciation is 0. It's a new construction home. There is no renovations or appreciation to be forced in this situation, meaning that the total year 1 ROI in this situation is 27.92%. So if these financials look attractive to you, or if you're eager to learn more about how you can secure a property of this nature, please, if you haven't done so already, be sure to sign up for our Deal of the Week and our free investors report for both Hamilton and the Niagara region, simply by clicking the registration link in our booth. I hope you found this insightful and looking forward to helping you achieve your real estate goals in the future.